$700 billion. I mean, I have been staring at that number in our research notes for like the last hour, and I still can't quite wrap my head around it. It feels less like a budget line item and more like a typo, or maybe the GDP of a mid-sized European nation, but apparently that is the reality of the week we just lived through.
It is absolutely not a typo. If anything, it's a down payment on the future. But you are right. It is a staggering figure.
Welcome back to the deep dive. It is Friday, February 6th, 2026. If you have been watching your portfolio or just, reading the headlines this week, you probably have a serious case of whiplash. We saw market valuations swing by trillions with a T in a matter of days, and it all seems to hinge on this massive high-stakes bet that big tech is making.
We are witnessing what I think history is going to look back on as the put up or shut up moment for artificial intelligence. For the last few years, we've been in the hype phase. Everyone's excited about the potential now. We have moved squarely into the checkbook phase, and the checkbook is getting absolutely hammered.
Okay, let's unpack this. We have a few massive stories to cover today. We've got this AI spending spree. We've got a total meltdown in the auto industry with Stellantis and Toyota and some serious boardroom drama at Disney and Netflix. But we have to start with the money. $700 billion. Where is that even coming from?
Well, that is the estimated capital expenditure, or CapEx, for 2026.
For the whole industry.
No, just for the big four: Amazon, Alphabet, Microsoft, and Meta.
Hold on. Let's pause there for a second. We hear CapEx thrown around a lot on financial news, just to make sure we are all on the same page. This isn't salaries for engineers, right? This isn't marketing budgets.
Correct. CapEx is hard assets. It is infrastructure. It is pouring concrete for new data centers. It's digging trenches for fiber optic cables. It's upgrading the energy grid. And most importantly, it is buying mountains of those incredibly expensive NVIDIA chips. This is money spent on physical things that are supposed to generate value for years to come.
Okay, so it's an investment. But the headline shocker this week was Amazon. I saw the stock took a nosedive, fell over 10% immediately. What exactly did they announce that scared everyone so much?
They warned that their 2026 CapEx will hit roughly $200 billion.
$200 billion just for Amazon. That sounds insane.
It is roughly the GDP of Greece, just spent by one company in 1 year. And yes, the market hated it.
Why, though? I thought Wall Street loved AI. Every time someone says AI on an earnings call, the stock usually goes up. Why punish them for actually building it?
Because the mood has shifted. Investors are looking at these numbers and doing a very simple, very cold calculation. They're saying, okay, you are spending $200 billion on AWS and AI infrastructure. When exactly do we get $201 billion back?
And the answer isn't next Tuesday.
The answer might not even be next year. That is the problem. It's a massive transfer of wealth from software companies to hardware infrastructure. Investors are terrified that the return on investment, the ROI, isn't going to justify the spend. It's a classic show me the money moment, and right now big tech is just showing them the receipts for the equipment.
It wasn't just Amazon, though. Alphabet, Google's parent company, is doing the same thing.
They are in the exact same boat. They doubled their planned 2026 spend to somewhere between, I think it was 175 and 185 billion. So between just those two companies, you are approaching $500 billion.
But here's what I don't get. These are smart people running these companies. If they know the stock market is going to punish them, and they know the ROI is years away, why do it? Are they just being stubborn?
It's not stubbornness, it's survival. It is the ultimate prisoner's dilemma. If Google stops spending, they risk falling behind Microsoft. If Microsoft stops, they risk falling behind Amazon. They are all terrified of becoming the Yahoo of the AI era. The company that was huge, got comfortable, didn't invest in the next wave, and, well, basically disappeared into irrelevance.
So they are spending this money out of fear.
Fear and ambition. They're betting that whoever owns the infrastructure owns the next decade of the global economy. But that doesn't help your 401k today.
Speaking of 401ks, this triggered a massive sell-off. The Magnificent Seven, Apple, Amazon, Google, NVIDIA, Tesla, Meta, Microsoft, they erased nearly $3 trillion in market cap.
There's a classic risk-off mood. When the bill comes due, people get scared. But here's where it gets fascinating. You asked earlier, why punish them? Well, not everyone was punished.
Right, because that $700 billion doesn't just evaporate. It goes into someone's bank account. Who is catching the money?
Exactly. One company's expense is another company's revenue. While the spenders tanked, the sellers rallied. NVIDIA is the obvious one. They sell the chips. But look at the secondary players. Broadcom, Supermicro, and here's the one that really caught my eye, energy.
energy stocks, like oil and gas.
And nuclear. You can't run a massive AI data center on hopes and dreams. You need electricity, massive, consistent baseload power. We saw stocks like NuScale, which is developing small modular nuclear reactors, jump up. The market is realizing that AI isn't just code in the cloud, it is heady industry. It needs power plants, cooling towers, and copper wire.
So the pick and shovel strategy is still alive and well. You don't mine for gold, you sell the shovels, or in this case, the nuclear reactors.
Precisely. But there was another group of losers this week that I think is actually more significant than Amazon's stock drop. We need to talk about the SaaS massacre.
SaaS software as a service. We're talking about companies like Salesforce, Workday, LegalZoom.
Correct. The companies that charge you a monthly subscription to use their tools. They took a beating this week, and it wasn't just because of their earnings reports. It was an existential crisis.
Is this related to those new AI agents I keep reading about?
It is directly related. Look at Anthropic's new Cowork feature or the new tools from OpenAI. The promise of these AI agents is that they don't just write a poem for you. They do the work. They can manage a customer relationship database. They can file legal paperwork. They can manage HR benefits.
I see where you're going. If I'm a CEO and I can pay, what, $20 a month for an AI agent to update my customer logs, why am I paying Salesforce $300 a month for a seat license for a human to do it?
Bingo. The entire business model of SaaS for the last 20 years has been seat licenses charging per human user. If AI reduces the number of humans needed to do the job, or if the AI becomes the software interface itself, that revenue just evaporates.
So it's not just that AI is expensive to build, it's that AI might eat the businesses that are currently paying for it.
That is the fear. Investors are worried about revenue compression. They are seeing a future where software gets cheaper and more automated, which is great for you and me, but terrible for Salesforce's stock price.
That is a dark but accurate summary of the week in tech. Okay, that's the digital world trillions being spent on a future that might eat the present. Let's pivot to the physical world. Because if tech is betting the farm on the future, it feels like the auto industry is crashing hard into the reality of the present.
Crashing is the right word. We have a tale of two automakers this week, Stellantis and Toyota, and they are moving in completely opposite directions.
Let's start with the bad news, Stellantis. This is the massive conglomerate Jeep, Dodge, Chrysler, Peugeot. What happened there?
It was a bloodbath. Stellantis warned of a 22.2 billion euro charge.
Wait, write down. It's just vanishing money.
Basically, yes, it's an impairment charge. They are admitting that the value of their assets is significantly lower than they previously claimed. And the reason is specifically because they are scaling back their EV push. They suspended their 2026 dividend, and the stock plunged over 20%.
So they bet big on EVs, built the factories, and now they're saying, never mind.
They overestimated demand.
Yeah.
Drastically. They built the supply chains for a pure electric future that consumers simply aren't buying into fast enough. So now they're forced to pivot back to internal combustion engines and, hybrids.
Which brings us to Toyota.
The company that every tech journalist called a dinosaur 2 years ago.
I remember the headlines. Toyota's falling behind. Toyota hates EVs. Toyota is the new Kodak.
And now, Toyota is taking a victory lap. They just named a new CEO, Kenta Khan. Interestingly, he was the CFO, which signals a focus on profitability over visionary hype, and they actually lifted their profit outlook. Why? Because they have the best hybrids on the market.
So the strategy of, let's not go all in on electric just yet, let's give people hybrids, actually paid off.
It is validating pragmatism. The consumer is saying, I want to save gas, but I'm worried about charging infrastructure and range. Sure. Toyota has the answer. Stellantis didn't.
It is fascinating how quickly that narrative flipped, but it's not just consumer demand causing headaches, is it? The government is getting involved, too. I saw Canada announce a new auto policy this week.
Yes, Ottawa unveiled some stricter emission standards and new incentives. They are desperately trying to spur domestic EV production to offset the trade wars happening with the U.S. But the real shadow hanging over all of this, and the reason Detroit is sweating, is China.
The Chinese EVs, we keep hearing about them.
Companies like Geely and BYD, they are producing high-quality electric cars at a price point that Detroit simply cannot match. I'm talking $12,000, maybe $15,000 EVs that are actually good.
But aren't there massive tariffs to keep them out?
Huge tariffs. But the fear is that even with tariffs, the Chinese cars might still be competitive, or they might set up factories in Mexico to bypass the rules. The Detroit giants, GM, Ford, are recalibrating their entire existence because they know a flood of low-cost competition is coming eventually. They're trying to get lean before the wave hits.
So you have the tech industry spending $700 billion on offense and the auto industry playing desperate defense.
That is the bifurcation of the economy right now. Offense versus defense.
Let's move to our third pillar, the boardroom. Because while the engineers are panicking about AI and the factory workers are pivoting to hybrids, the executives are playing a high-stakes game of musical chairs.
And the music stopped at Disney this week.
Finally, the succession drama is over.
It seems so. Disney officially named Josh D'Amaro as the next CEO, effective March 18.
He's the current head of Parks and Experiences, right? The guy who is always seen walking through Disneyland high-fiving people.
Exactly. He is the Disney adult favorite. He's a brand guy, very popular with the fan base and the cast members. And to balance him out, Dana Walden is taking the role of president and chief creative officer. It's a split leadership structure that tries to balance the business operations with the creative output.
But our sources mention a whisper on Wall Street. Now that they have a new boss, what happens next?
The chatter about an ESPN spinoff is back.
Really? I thought Bob Iger killed that idea.
Iger flirted with it, then pulled back. But the theory now is that D'Amaro might be the one to actually pull the trigger.
But why? ESPN makes money. Why get rid of it?
It makes money, but it's a declining asset in the cable bundle world. It drags down Disney's growth narrative. If you spin it off, Disney becomes a pure content and parks play IP and experiences, which Wall Street might value higher. It's just financial engineering.
Interesting. But if we're talking about massive media shakeups, we have to talk about Netflix. They want to buy Warner Bros. Discovery for $83 billion.
A staggering number. It would be the media merger of the century.
Yeah.
Netflix buying HBO, essentially.
It sounds illegal, or at least like a monopoly.
The Department of Justice seems to agree with you. The DOJ has widened its probe significantly. They are subpoenaing industry peers, asking, if this happens, can you still compete?
And just to make it messier, Paramount is trying to get involved too.
Paramount threw in a rival bid. It's absolute chaos. You have Netflix trying to buy the prestige of HBO, Paramount trying to save itself from irrelevance, and the government trying to stop all of it.
Speaking of the government stopping things, we need to do a rapid-fire round on regulations. Because the courts were busy this week, and some of these rulings are scary for the tech world.
Which one stood out to you?
The Uber case. A jury found Uber liable for $8.5 million in a sexual assault case. But the specific wording. They called the driver an agent of the company.
That is the legal term that should make every gig economy CEO sweat. Uber has built its entire $150 billion business on one premise. We're just a tech platform. We are an app. The drivers are independent contractors. We aren't responsible for them.
And this jury said, no, actually you are.
Exactly. If a higher court upholds that the driver is an agent, it implies an employment-like relationship. It opens the door to Uber being liable for every accident, every assault, every dispute. It fundamentally breaks the economic model of the gig economy.
That's huge. And then over in Europe, TikTok is getting hammered.
The European Commission ruled that TikTok breached the Digital Services Act, specifically regarding addictive design and risks to children.
So they aren't just fining them for bad content. They are going after the algorithm itself.
They are attacking the core product, the For You feed, that keeps you scrolling for 3 hours when you only meant to watch one video. They are saying that design is inherently harmful to minors. This isn't just a fine. This could force them to redesign how the app works.
That is a direct challenge to the attention economy. And briefly, closer to home, the Washington Post. Jeff Bezos is taking a lot of heat.
Mass layoffs, editorial shifts. It's a classic case of a tech billionaire struggling to manage a legacy media institution. He's trying to run it like Amazon efficient, lean, data-driven, and the newsroom is revolting. It raises questions about whether the tech mindset actually works for civic institutions like newspapers.
Okay, let's take a breath. We've covered AI trillions, auto pivots, media mergers, and legal battles.
I want to zoom out. I want to look at the actual economy. Because we have all this corporate drama, but what is happening on Main Street?
The economic weather report is, well, it's confusing. It's contradictory.
Give me the bad news first.
The labor market is cooling, fast. U.S. job openings just hit a 5-year low. We are down to 6.54 million openings. That's the lowest since the pandemic started in 2020.
And we're seeing layoffs, UPS, Amazon, the Washington Post, like we mentioned.
Right. So if you look at the job market, you'd say, uh-oh, recession coming. But then you look at the stock market, and the Dow hit 50,000.
For the first time ever. It closed above 50,000 this week.
How is that possible? Tech is crashing, jobs are vanishing, and the Dow is at a record high.
It's a rotation. Investors pulled money out of the risky AI tech stocks we talked about, and where do they put it? Into safe, boring stocks, banks, healthcare, industrials. That pushed the Dow up, but it creates this weird vibe. The stock market is partying, but the job market is closing up shop.
It feels like a white-collar recession, doesn't it? The layoffs are in tech and media, the profits are in the market.
That is a very apt description. And to add one more layer of anxiety, there is drama at the Fed.
The Treasury Secretary Scott Bessent.
He implied that the president might intervene if the Fed chair nominee Kevin Warsh resists rate cuts.
That's a big taboo. You don't mess with the Fed.
Fed independence is sacred to the markets. If investors think politics is dictating interest rates, cutting rates just to boost the economy before an election, for example, rather than because the data supports it, it destroys credibility. Inflation could spike. It spooked the bond market significantly.
It feels like everything is just a little bit on edge.
Yeah.
But before we wrap up, we always like to look at the wait what news. The stuff that flies under the radar but tells us something about where the world is going.
I love this part. What caught your eye?
Hims and Hers, the telehealth company. They launched a GLP-1 pill, that's the weight loss stuff, like Ozempic, for $49 a month.
That is an absolute bombshell.
Usually those drugs are like, what, $1,000 a month if you don't have insurance? How are they doing it for $49?
It's a compounded version. They're using a loophole in FDA regulations that allows pharmacies to make their own versions of drugs when there is a shortage. But pricing it at $49, that is a direct declaration of war against Novo Nordisk and Eli Lilly.
I imagine the lawyers at Big Pharma are working overtime this weekend.
Oh, the lawsuits are definitely coming. But for the consumer, this is massive. It democratizes access to the most popular drug in the world overnight.
What else? I saw Bitcoin took a tumble.
A big one. It fell 30%, heading towards 60,000.
Is there a reason? Or just crypto being crypto?
Traders are blaming thin liquidity. But really, it's a reminder. Bitcoin is still a risk asset. When the market got scared about the AI spend, they sold tech and they sold crypto. It's not the digital gold safe haven people want it to be yet.
And here is my favorite weird one. Pandora, the mall jewelry store.
This is a great little economics lesson.
They're launching platinum-plated jewelry. Why?
Because silver's too expensive. The price of silver has spiked, partly because silver is used in solar panels and electronics. So Pandora is seeing their raw material costs explode.
So they switched to platinum. Isn't platinum more expensive?
Platinum plating. They're using a tiny layer of platinum over a cheaper metal core to avoid using solid silver. It's called skimpflation, or innovation, depending on how you look at it.
Yeah.
But it shows how commodity prices force companies to change the actual product on the shelf.
And finally, let's end on a tiny bit of good news, because we've been pretty doom and gloom. Once Upon a Farm.
The Organic Kids Food Company. Jennifer Garner is involved with them.
They had an IPO.
They did, and it popped 17% on the debut.
In a week where Amazon tanked and Stellantis crashed, the baby food company won.
It's a nice reminder. Even in a market obsessed with AI chips and nuclear reactors, people still need to feed their kids. Good consumer brands that solve a real problem can still win.
I love that. Okay, we have covered a massive amount of ground, from $700 billion AI bets to $49 weight loss pills. How do we synthesize this? What is the big takeaway?
I think the theme of this week is the split. We are seeing a bifurcation of the economy.
Explain that.
On one side, you have the tech giants. They're operating on a timeline of decades. They're spending $700 billion on a future that doesn't exist yet, building the brain of the planet.
And on the other side,
You have the industrial giants, like the automakers, who are being forced to retreat to the present. They tried to sell the future, EVs, and the consumer said no. So they are pivoting back to hybrids to survive today.
it's a split-screen economy. The future is being built at a cost of trillions, but the present is demanding efficiency and profitability right now.
Exactly. And the volatility we are seeing, the stock crashes, the layoffs, that is just the friction heat generated by these two tectonic plates grinding against each other.
So here's the question I want to leave you with. We talked about job openings hitting a 5-year low. We talked about AI agents threatening to replace software subscriptions and the humans who use them. We see companies spending billions on automation. Are we looking at an efficiency boom that will make everything cheaper and better? Or are we heading toward a demand crisis?
That's the fear. If the robots make everything, but nobody has a job to buy it. The math doesn't work.
Something to think about over the weekend while you drive your hybrid to the grocery store. Thank you for listening to this deep dive.
Stay curious